Yeah. All right. From this point of view, from this point now, I believe that you now know what lease is. You now know that when dealing with lease, you need to distinguish between an operating lease and a finance lease. You have to note down the point, right? But also you need to know that in the books or in an exam, you may be required to deal with the leasee section or the lessor section. At which point, when dealing with the leasee section, there is no need to distinguish between operating lease and finance lease, no need at all. But when dealing with the lessor side, you need to distinguish on whether the lease is a finance lease or the lease is an operating lease. I hope you know that those points now. You can just write them down. It's a very, very important point. I'm repeating again. When dealing with a lease, you can have an operating lease or a finance lease. Now, when speaking of the lease again, you have the lessor, but also you have the lessee. As for the lessee, there is no need to distinguish between the finance lease and operating lease. But as for the lessor, you need to distinguish between operating lease and finance lease. That's a very, very basic thing when dealing with this IFRS, right? Okay. So actually, Julia, defining a lease, let's see accounting. As you see, the lessor accounting. I'm repeating for the last time. When dealing with the lease accounting, there is no need to distinguish between operating lease and finance lease. But when dealing with lessor accounting, you really need to distinguish between operating lease and finance lease. And then there is something called sale and lease back. You know, you have your house, you say that you tell someone, oh, I'm selling my house for 100 million. Then after receiving that, but you say that, oh, I'm selling for 100 million, but after that, you have to rent it back to me. So I sell it, give me 100 million, but I'll still stay in this house and I will be paying you. That's what we call selling the lease and selling the lease back. Actually, we'll take a look at the term. So as for now, just ignore that one. Now let's deal with lease accounting. So as you see, we spoke of lease, we spoke of the lessor, we spoke of the lessee, the right of use the asset, something like that. Now remember, I said that the lease is a contract or part of a contract. So when you read a question, you really need to know whether there is a lease or not. A lease should be a contract. If you find out any terms that not constitute a contract, you just say that this is not a lease. All right. For example, IFRS 16 leases requires lessees to recognize an asset and a liability. I think among the points that are very, very important, this is just a single line, but it is super essential. Let me write it down in form of double entry. They just wrote it that way, but I would like to put it in the form of double entry. What they have written there, they just mean this. You just need to debit right of use assets by a certain amount, let's say XXX, and then you need to credit lease liability. This is the major point that is needed. So you really need to know this. Regardless of whether it is an operating lease or a finance lease, as long as you are a lessee, as long as you are what? You are a lessee, you are the one seeking that asset, seeking the use of that asset. That's why we say there is lessee accounting and lessor accounting. You need to know this. You have to recognize the right that you have the right to an asset, but also you have to say that you are obliged to pay the rent and other other payments on which you have agreed to the lessor. This is the very, very important point, and it is what we'll be dealing with all along until we complete the lessee accounting. So also note it down. That's why they say a lessee should recognize an asset, which is the right of use asset, not a real asset, it's just the right of use asset, and a liability, which is the lease liability, unless they are short-term or of a minimal value. As for IFRS 16, you know, there are some situations that requires to simplify the way of actually dealing with the lease. They simplify complications. If the lease is a very short term, we usually just expense it, just like, you know, the rent, usually expense the rent, usually take rent as an expense, just expense in the income statement and everything is done. Or maybe if it's a minimum value, you can also do that. But actually, the standard does not specify what is the minimum value, but it specifies some assets which you can regard to be of minimum value. We'll just see that. So it's no big deal. And then they say, as such, it is vital to assess whether the contract contains a lease or whether it is simply a contract for a service. So this means that if a contract contains a lease, that means you have to comply with this, unless maybe the lease is of a low value. But if there is no lease, maybe it's just the contract for service, then no problem. You can just recognize your lease rent, just rent for lease is a normal expense, as we usually do. Okay, now how do you know whether a contract has a lease? Of course, in an exam, this is usually obvious. Here we are just doing, actually just doing this kind of thing, but in an exam, it will be obvious. A contract contains a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. As we said, if you say that there is a lease, that means you give out something, you give out an asset, an underlying asset. Someone gets that underlying asset and puts it under control for a given period of time, and then they pay you back. They pay you something. Of course, if you're just giving something to someone, they don't pay you anything. That's not lease. That's not the lease. It's just a help. So that's what you really need to consider. Okay, now we can just go further. Let's just go further and see what we can do. Here, now say the customer control the assets. Now, this is just a normal definition of control. Even in the conceptual frameworks, you just find it. The customer controls the asset if it has the right to substantially all the identified assets' economic benefits and the right to direct the intended assets use. We usually say that even the conceptual framework just says that you have control when you can direct the use of the asset and prevent others from accessing those benefits. If you can just refer from that normal definition in the conceptual framework. But here we are dealing with the specific standard. So you also have to consider this, the right to substantially all of the identified assets, economic benefits, just like this. All right, then proceeding, we are told that the right to direct the use can still exist if the lessor puts restrictions. Now, you know, you have to understand when you are reading something. When you are dealing with advanced financial reporting subjects, you really need to know the importance of this thing. This thing can just come on an exam. They just give you as a word, as a sentence. You really need to read that and spot that what they mean here. That's what you need to do. They say that the right to direct the use of an asset can still exist if the lessor puts restrictions on the use within a contract. You know, someone has told you, oh, okay, no problem, I'm giving you my machine, but don't get this machine out of Tanzania. You cannot say, oh, I cannot control, I've been restricted the use has been restricted that I cannot get it out of Tanzania. Or maybe I'm not allowed to use it maybe for 24 hours. No, you can still just direct the use, but there is just a restriction. So a restriction does not negate, I'm repeating again, a restriction does not negate the ability, the right to direct use. There's an example here, such as, for example, by keeping the maximum mileage of a vehicle. Someone has rented out a vehicle to you and they're telling you that, oh, make sure that by the time you return this vehicle, you should not have exceeded a certain number of kilometers. That's not prevention of directing use. No, it's just a restriction. Or maybe limiting which countries an asset can be used in. Yes, this is just an example that I gave. These restrictions define the scope of the leasee's right of use rather than preventing them from directing use. This is a very, very important point for the advanced financial reporting. It is the difference between financial reporting and the advanced financial reporting. So in advanced financial reporting, you read this, you should be able to spot that, oh, so this is still a lease. It's no problem. It's still a lease and there is still control here. Okay. So before going to computations, I say that IFRS 16 said that a customer does not have the right to use an identified asset if the supplier has the practical ability to substitute the asset for an alternative, and if it would be economically beneficial for them to do so. Can anyone explain this? What this statement meant? They are just trying to continue showing you that there can be something that there is just the scope, not the limitation, but this one is the limitation. You see this? This one is the limitation. Maybe you have two types of cars. Maybe the lessor has two types of cars. The lessor has car A and car B. Then the lessor has rented to you car A, but the lessor says that, oh, whenever I decide to come and substitute car A for car B, do not blame me. You just have to accept. The lessor at a certain point in time comes, exchanges those vehicles for you, and in turn generates benefits, economically benefits from that. It still means that there are still benefits that the lessor can get from you, although actually the asset sits under you. So if you say that this statement is negated, the right to substantial or identified economic benefits, no, you are the one who could have done that, but you are being prevented from enjoying those benefits so that the lessor can enjoy that. So we say that, oh, in that case, there is no control, right? So you really need to read the sentences and between the lines when dealing with the subject. Okay, I don't advance financial reporting because before going into computations, you need to understand. For example, just look at this question. Instead of just going to computation, debit what, credit what, they're just giving this question so that you read and understand. You see, after this one, you just come to the accounting here. Accounting here is very easy, but you really need to go through this first. For example, here, let's take a look, maybe at just this first one example, test understanding number one. The question just requires you to know whether a contract contains a lease. You may read a question and say, oh, there is a lease here, while there is no. The question says, Coffee Bean enters into a contract with an airport operator to use some space in the airport to sell its goods from the portable kiosks for a 3-year period. Very nice. They have entered into a contract. Then Coffee Bean owns the portable kiosks. So those kiosks are actually under the ownership of Coffee Bean. No problem. Maybe it's an issue of space, something like that. The contract stipulates the amount of space and states that the space may be located at any one of several departure areas within the airport. So Coffee Bean is given autonomy on the place to locate those movable kiosks, right? Something like that. And then the question proceeds and says, the airport operator can change the location of the space allocated to the Coffee Bean at any time during the period of use. Now, do you see, the airport operator can just decide. It's not like Coffee Bean can just go and choose anywhere. No, they can choose anywhere, but still the airport operator can change that location. And the cost that the airport operator would incur to do this would be minimal. Now, do you see this extra sentence? The airport operator can do that at a minimal cost. That means that the airport operator can benefit because they will not just shift something without getting benefits. They shift because they expect to gain some benefits and the costs are minimal. It means that the airport operator can still gain something, although it seems that Coffee Bean has already been granted the rights to locate their own business. So here we are told there are many areas in the airport that are suitable for the portable kiosks. So there are many areas that are suitable, but still the airport controller can just change according to their wishes, and the cost would be minimal. So the question says that the contract contains a lease. Now you are given a question like this in an exam. If you just need to explain and see whether there is a contract or not, you have to refer to the standard, to what the standard says. Don't just say, oh, there's a contract or there is no contract. You have to specify that. Now, Maybe before proceeding, who could help us with this? Who could help us? Does the contract contain a lease or no? Does the contract contain a lease or not? We're given the points here. The customer controls the asset if it has the right to substantial of the identified assets, the right to direct the identified assets use. That the customer has the right to direct the identified assets use or not. Now, you really have to see something. Let me. This is first understanding number one. Let's go. It's number one. You really have to know how to answer these questions in an exam. Here, you see, you have this answer, but you have to start. In an exam, you need to know how to start with this. First of all, the contract does not contain a lease because there is no identified asset. Because what did we say? We said that a lease is a contract or part of a contract that conveys the rights to the lessee to an underlying asset. And in turn, the consideration is paid to the lessor. They just talk here, but actually there is no identified asset for which actually is being given there. It is not identified because we just thought, oh, you can just use this space, this space, this space. It is not identified. What is really given? All right. So if we just start with that, we can say that the contract is for space in the airport. You can just say, oh, the space is an asset. Is an asset that I'm just giving, but it is not known. You can just be changed at any time. That's why I say, and the airport operator has the practical right to substitute this during the period of use. I think you already saw this in a question. They can change it, so there is no identifiable asset. There is no an underlying asset. Why that can they change? There are many areas available in the airport that would meet the contract term, providing the operator with the practical ability to substitute. But also the airport operator would benefit economically from substituting the space because there would be minimal cost associated with it. And this would allow the operator to make the most effective use of the available space, thus maximizing the profits. So this still means that the operator can still gain the benefits, the returns from the lessee. So those are the things that you just have to take a look at. Now I would leave this second point to you. This second question is just the same, but you really need to read this and decide. Maybe let us just read it, and then I'll leave it to you for you to decide. The question says AFG enters into a contract with Splash, the supplier, to use a specified ship for a 5-year period. Okay, no problem. It's a contract entered into. Now read the condition. Splash has no substitution rights. Now do you get this? AFG enters into contract with Splash, the supplier. Splash is the supplier. So AFG is the one that is obtaining the rights to use what? To use that ship. And then Splash has no substitution rights. Now, this question is a bit different from the above one. This time now, Splash cannot just decide, cannot just substitute maybe one ship for another, or maybe one ship for anything else. So the underlying asset is known, it is a ship. Then, during the contract period, AFG decides what cargo will be transported. AFG is the one who has acquired the ship, and lease, it can decide what will be transported. That's good because it shows control. They can decide, they can direct use. When the ship will sail, they can direct that, and to which ports it will sail. AFG is having such an autonomy. That's good. However, now there are some restrictions specified in the contract. Those restrictions prevent AFG from carrying hazardous materials as cargo or from sailing the ship into waters where piracy is a risk. Now, do you see this? This does not actually take away the ability to direct use, but it just specifies the scope of the contract. As long as AFG actually agrees to that, it's just a limitation of the contract, a limitation of the scope, but it is not actually the privation of the ability to direct use. Okay, further conditions. Splash operates and maintains the ship and is responsible for the safe passage of the cargo on board the ship. Actually, all the risks are on Splash, right? Operates and maintains the ship, all the costs. FG is prohibited from hiring another operator for the ship. I mean, Splash was the one who gave the what? The ship. Splash operates and maintains the ship and responsible for the safe passage of the cargo on board. Now, actually, this one does not have so much a big issue because when dealing with an operating lease and finance lease, you can just speak about this matter. So it's no big deal. We are told here that FG, the lessee now, is prohibited from hiring another operator for the ship and from operating the ship itself during the term of the contract. So it's just something like that. You are given such questions and then you are told that the contract contains a lease or not. So these two questions just help you. They just give you a picture of how you can just tackle the question in advanced financial reporting. It's not bad, you can just go through it too. Now, by starting, you say that FG has the right to use an identified asset. Now it's known there is an identified asset, not like before. It is specific ship for a period of time, that is 5 years, and the Splash cannot substitute, no substitution right. So the asset is really known, unlike for the first question. But also FG has the right to control the use of the ship through the 5-year period that was stated. And why now? Because first of all, it has the right to obtain substantial or the economic benefit from the ship of the year due to exclusive use of the ship. We are told that they can decide where to sail, what time to sail, something like that. Although we saw that there are some restrictions, it had the right to direct the use of the ship. Although, as we said, there are some restrictions. Now the restrictions actually just define the scope. So these ones would not restrict, would not prevent it from saying that there is a lease. Now, if you just proceed at the last point here, we say that Splash's operation and the maintenance of the ship does not prevent AFG from directing how and for what purpose. As I told you that this is irrelevant, maybe it can just come later and see whether this is an operating lease or finance lease, which is of no concern right now. Therefore, based on the above, the contract contains a lease. Of course, in an exam, most of the times you won't be required to specify this, but you really need to know how to go about this issue, right? Okay, now we are done with explanations, a lot of tea. Now let's go to real business. We're just now getting to real business. We have this accounting, we have less accounting, and we have sale and lease back. After that, the standard is over. I would just like to remind you on whether you have ever had the concept of time value of money. There is one thing called time value of money. It's usually very irrelevant. I don't know how to obtain present value from future value. We are just going to need that logic because the questions here can just come the way they wish. Maybe let me make a reminder here before dealing with lease accounting. It's something very, very important. It's something very important. I hope you all remember about the time value of money. I hope you all did financial management in your studies, financial management. There is something called present value. How do you obtain present value? Present value is usually equal to future value divided by 1 plus, this R can be the cost of capital, can be the discount rate, anything. And then we raise it, what? I'm just trying to find out that. Maybe you say that you raise it to the power of N, something like that. You really need this one here. I'm repeating again. You are just going to really need it here. Really. Maybe before going any further, I would just like to speak of it before, because you cannot proceed without this. For example, let's say, let me say you have a year here, and let's say have the cash flows, just like that. Maybe at the end of year one, you have to pay for rent $100. At the end of year two, you have to pay for $100 again. Then at the end of year 3, we have to pay $100 again for the other time, just like this. Now, when we speak of the lease rentals, you have to determine the present value. Now, how do you obtain the present value? This is the future value because we are here now, but this is the end of year 1, end of year 2, end of year 3. Now, to bring the weight of the value at the end of year 3 now, it would obviously be less than 100. Because know that as you go into the future, there is something like inflation, but the purchasing power decreases. So actually the weight of 100 in 3 years' time would be less. Maybe it could be equivalent, let's say 80 or 70 or 75, something like that currently. Now to obtain that, you take this cash flow, which is like the future value, and you multiply it by this factor. We usually call it discount factor, DF. That discount factor is what we say 1 plus R raised to the power of minus n, negative n, just like that. So you have to do this, and maybe let's presume now this discount rate was 10%. 10% equals to 0.1. So it's something like that. 1 plus 0.1 would obviously be 1.1. So the discount factor could be 1.1. So you just come. For year 1, you plug that 1.1 power 1 to obtain, we usually obtain something like 0.909. You know, these are the common figures, so sometimes you can just remember them. And then here we usually have 0. I don't know, I'm just presuming 0.829, and maybe here you can have 0.751. Then you multiply by this one to obtain the present value. You multiply the cash flow and the discount factor to obtain the present value. So you find out 100 times 0.909. This one would be 90.9, something like this. And then multiply again 100 times 0.829, and you would have 82.9. And then 100 times 0.751 would have 75.1, right? 75.1, something like this. If you add this up, you obtain the present value. My friends, note that this one would be your business when dealing with the lease, and not just lease. I suggest that you start being conversant with this. If for financial instruments, will encounter this. Actually, even when dealing with impairment of assets, it's something we're going to.
I didn't get that. What did you say?